Hi, I'm Stephen Dooley, Head of Market Insights at Convera, and I'm looking at our global FX outlook for February 2026. Well, calling the start of 2026 eventful barely scratches the surface. In just a few weeks, we've moved from news around the Venezuela operation, renewed tensions involving Iran, and the unexpected Greenland episode. Tariff threats have continued to simmer. The Trump power feud has flared back into view. Japan's bond market turmoil sparked speculation about coordinated intervention, and President Trump announced Kevin Warsh as the new Federal Reserve Chair. In such an eventful start to the year, where do we start? Well, of course, we start on the US dollar. The greenback fell to a 4-year low in January, and it was pressured somewhat by these geopolitical tensions and uncertainty about the US political system, particularly around some of those pressures on the Federal Reserve. We saw the US dollar index fall to a 4-year low, but it did recover and it was helped partly by better US economic data, but also by the announcement of the new appointee to the Federal Reserve Chair, Kevin Warsh. We also mentioned coordinated FX efforts that we saw in the middle of the month, and that was mainly driven by the sharp weakening in the Japanese yen. We heard verbal intervention in the form of rate checks from the Federal Reserve and the Bank of Japan, pushing the US dollar Japanese yen pair down from around 160 down to 152. The yen has been weakening ahead of this month's national election. Both Japanese key candidates have been promising big spending programs. Markets will be closely watching the results of those elections. And then, of course, even after all the moves we saw in financial market, volatility has remained relatively contained. So markets are still trying to wrestle what the long-term outlook, what the long-term impact will be from so many different factors. But we can certainly expect to see further moves and further volatility in 2026. Markets will be looking to key economic data this month. In the first week, particularly focused on those US job numbers out on the Friday. We also have a rate decision from the Bank of England and the European Central Bank. Week two, particularly looking at US inflation, that will be critical in terms of the Federal Reserve's next move. Then as we go into week three, a whole series of economic releases, particularly Q4 GDP from the US, along with PCE inflation. We also get a whole range of those industry purchasing manager index numbers, the most up-to-date reading of the global economy. And then as we get to the end of the month with week four, looking closely at US consumer confidence, Australian inflation, and a rate decision from the People's Bank of China. As we look through the major markets and what we saw in January, well, the British pound was one of the currencies. Many of the major currencies managed to benefit from that US dollar weakness, but the British pound in particular, 7% above its 5-year average, and the British pound US dollar pair at the highest level since 2021. So it was a strong month for the British pound, although it did give back some of those gains near the end of the month. Looking forward, that move in the British pound certainly pushed it to an extreme. You can see the top end of the range there, up around that 137 level. And certainly there is the potential, at least from a fundamental perspective, that the British pound can fall back from its recent highs. Of course, there are a lot more going on in financial markets than just fundamentals, and the market dynamics and the concerns around the debasement of the US dollar, particularly what we're seeing in the precious metals markets, is another factor driving markets as well. As we move on to the euro, historic month in January for the euro, above 120 briefly in the euro US dollar pair, and the euro was stronger in other markets as well. Again, like we saw with the British pound, the euro has moved up towards the top of the range. Not quite as stretched. The euro has potential for further gains into this year. But for now, that 120 level did cap a short-term peak in the euro US dollar pair. And you can see our baseline forecast, at least for the first 6 months of the year, around that 117 level. Moving on to the APAC region, and the Australian dollar also had a strong month in January. It was helped not just by that US dollar weakness, but by expectations that the Reserve Bank of Australia might consider a rate hike when it meets in early February. Strong inflation numbers and better than expected unemployment numbers have both seemed to suggest the Australian economy is performing well. And you can see the Australian dollar here at a modest premium, as we've called it, versus the US dollar. And if we look here at the overall range, again, like we've seen with some other currency pairs, that US dollar move to 4-year lows saw the Aussie dollar move up towards the top end of its recent range, most likely in terms of fair value from a fundamental perspective, around that 65 to 67 level for the Aussie dollar. And then finally, turning our attention to the Canadian dollar, the dollar CAD was also lower, in line with some of the markets that we saw as that US dollar weakened. And we can see that the dollar CAD moved right back down to the lower end of that recent range. Again, that seems to be a extreme in terms of the short-term valuations on the dollar CAD, and there is the potential for that to rebound up towards that 137, 138 level. But as we progress into the year, the story of the US dollar and whether it can reassert its fundamentals, its relatively strong growth dynamics, or whether it continues to be driven by more of the market positioning, will be critical for how the US dollar performs against those major markets that we have just covered. So, as we wrap up the global FX outlook report for the month of February, what are we thinking? Well, more important than ever for businesses, for making payments internationally, managing the impact of currency volatility, the impact of geopolitics, and the impact of shifting sanctions is more important than ever. We can help you here at Convera with our strong local knowledge and global expanse. We're able to help you manage those international payments. If you have any questions, you can contact us here on the Ask Market Insights, convera.com email. And I'd like to thank you all for watching the video today. Thank you.